In the first consolidation working video to accompany the module devoted to dealing with intra-group trading, we will build on scenarios already introduced in previous modules, but this time assuming that inventory is being transferred between the parent and its subsidiary. So example 1 reads, P acquired 80% of the share capital of S for €8,000 on the 1st of January 2017, when the statement of financial position of S was as follows. We are additionally told that the group uses the fair value approach to measure goodwill, and that the fair value of the 20% non-controlling interest was €2,000 at the date of acquisition. Reading on the 31st of December 2017, the statements of financial position of the two companies are as follows. We are also told that over the course of 2017, P sold goods to S at a price of €1,800, which included a markup of 50%. 1/3 of the goods remains in inventory as at the 31st of December 2017. And our job is to prepare a consolidated statement of financial position as at the 31st of December. As always, the first working concerns group structure, and we write that P owns 80% of S. The second working is subsidiary net assets, where we find the standard 3 columns and just 2 rows, seeing as no fair value adjustments are in fact required in respect of the subsidiary's net assets. So in the first column we will have 5,000 in respect of share capital and 3,000 for retained earnings. Moving on to the consolidation date column, we may input the relevant equity balances of S as at the 31st of December, that is 5,000 and 5,500 for share capital and retained earnings respectively. Because the intra-group transaction involved a sale from P to S, the entire unrealized profit element is included in the books of P, and no adjustments are therefore required to the retained earnings of S. Accordingly, the post-acquisition column shows nothing in respect of share capital and €2,500 for retained earnings. The third working, goodwill, begins with the €8,000 investment by the parent entity. Next comes the NCI value at acquisition, which, under the fair value approach, equals the €2,000 provided in the scenario. The two numbers are then added, giving a total of €10,000, from which we deduct the 8,000 fair value of the subsidiary's net assets as at the date of acquisition, which we take from the acquisition date column of working 2, and this yields a goodwill balance of €2,000. The fourth working begins with the non-controlling interest value at acquisition, and that's the €2,000 already identified as part of working 3. To this we must add the NCI's share of the subsidiary's post-acquisition reserves, and that's 20% of the post-acquisition column total from working 2, so 20% of 2,500, which gives another €500. Accordingly, the consolidation date NCI balance equals €2,500. The fifth and final working, group retained earnings, begins with the entire retained earnings of the parent as at the date of consolidation, giving 17,000, to which we add the parent's share of the movement in the net assets of S. This is equal to 80% of the outcome of the post-acquisition column from working 2. That is €2,000. As already noted, we must, however, adjust group retained earnings downwards for the unrealized profit resulting from intra-group trading. We are told that the goods were sold for a price of €1,800, which included a markup of 50%, implying that the profit realized on the transaction equaled 50% of the cost of goods sold. If you consider the cost of goods sold to correspond to 100%, then the transfer price must correspond to 150%. Hence, the profit element equals 50 of 150, or 2/3 of the price, which gives €600. Because only 1/3 of the goods are still in ACCA's inventory, the group retained earnings working includes a deduction for 1/3 of 600, or €200, which brings the consolidation date balance to €18,800. Let us now put all of the pieces together in the consolidated statement of financial position as at the 31st of December 2017. We begin with goodwill, which was computed as €2,000 in working 3. Next, we have other assets, which equal the sum of the two values coming from the books of P and S, but also reflect a deduction of €200 to eliminate the unrealized profit element included in the carrying amount of S's inventory, which brings the total to €31,800, resulting in overall assets of €33,800. Moving on to the equity section, the share capital of the group is always the same as the share capital of the parent, so €6,000. The group retained earnings total derived in working 5 was €18,800, whereas the carrying amount of non-controlling interest was €2,500 as computed in working 4, producing an overall consolidated equity balance of €27,300. Group liabilities are the sum of the relevant P and S numbers, coming in at €6,500, which brings the balance of consolidated equity and liabilities to €33,800.